Thank you and welcome to everyone. And I think most of the people here want to hear about the Indian markets, looking at it, sitting outside. And today we couldn't have a better panel over here to talk about the Indian markets. What we are going to try to do is to help you see India when you are also investing globally everywhere, what India brings to you and why India today. I'll move on to the dignitaries, and I would like to start with you, Hiren, and all three of you all. I want you all to take a case on India, 10 trillion economy, 2030, from a macro perspective, with the most expensive market. How do you look at growth here, and all things from a global investor perspective, how they should look at India?
So thanks, Sashi, and good afternoon, all of you. So when I saw the heading for our panel discussion, India emerging as a superpower, I said, "Wow, we already made India a superpower, right?" And I was thinking to myself that yes, there is a lot of optimism about India, and we share that optimism as Indians, as Indian portfolio managers. We've been in India for 30 plus years, and it's been a very exciting journey, whether the macro in India is done well or not done well. In general, investors in India have done very well. But since this term superpower came, I just jotted down a few ideas that what kind of a country can be a superpower? What are the dimensions before you can call a country a superpower, right? Obviously, the first thing is the size and scale of the economy. And I think there, clearly, India scores very well. We are no longer small. We are the fifth largest. Obviously, Mr. Modi has given a forward guidance that we will be the third largest very soon at 4.5 trillion, growing at 7%. We certainly tick mark as far as the size, scale, and the growth rate of the economy is concerned. The second dimension for being a superpower is that you need very strong defense capabilities, right? If you are a country which needs another country to save you from aggression, you can't be a superpower. So Germany can't be a superpower, or none of the European countries can be a superpower, because they have the NATO and they have the US backing them as far as defense is concerned. I think India can stand on its own. It doesn't require anybody else. Yes, I think in terms of defense capabilities, there is a lot that needs to be done in India. In fact, defense as a theme in India is very interesting from an investment perspective. But I think there is a lot of work that needs to be done. The third thing that you need to be a superpower is to be endowed with resources, whether it is energy or metals. I think there, India, as you know, is still dependent on crude oil. And if energy prices spike, that's definitely something that India's macro does get disturbed at some point in time. But as we move very fast towards renewables, I think that will change over a period of time. However, on the metal side, India is fairly well endowed, right? So we have our own iron ore. We have the fourth largest reserves of coal. We have our own alumina. And that differentiates us from, let's say, a country like China, which has no resources. It has to import all the resources from everywhere in the world. Fifth, you need certain foundational capabilities. For example, can you manufacture your own semiconductors? Or do you have computing capabilities and digital capabilities in this new age? I think there, as far as digital capabilities are concerned, I think India is way up. As far as semiconductor is concerned, I think we have a long way to catch up. But I think all the policy framework is going to come where we are trying to create a semiconductor ecosystem in India. And last but not the least, to be a superpower, you need soft power, right? US became a superpower because of its culture, Hollywood, and culture. In India, I think we have the soft power. I think Bollywood is equally a big theme. Indian food is loved across the world, and now even culture and tourism should grow by leaps and bounds. So I think I just thought that, just talking numbers and being bullish in India, I thought it was important to bring this multi-dimensional view of where we are. I think we are aspiring to be a superpower. There are a lot of areas, as I said, when it comes to economic size and growth rate, we are, we are there. When it comes to digital capabilities, we are out there. When it comes to resources, we are good. When it comes to soft power, we are there. But there's a lot of work that needs to be done elsewhere. Having said that, I think India by itself has emerged as an asset class, and I don't think that any serious investors can now afford to ignore India. So with that, I'll probably stop here, let some of my other panelists also talk about how they see India.
Nilesh, your views.
Yeah, thanks. I think Hiren gave a lot of perspective on many aspects, multidimensional. Let me sort of switch gear to markets and wealth creation aspect. I think whatever number you pick, 3.6, 3.7 trillion dollar, I doubt it will touch 10 trillion in 2030. The math doesn't. I mean, we'll grow at roughly around 6.5% real GDP and potentially slightly higher. And you add inflation of around 4.5%, 5%. So we are talking of 11, 12% nominal GDP growth, a very powerful number. We're talking of economy sort of doubling in 6 to 7 years. The question is, what is the confidence that it's not our birthright to have 6.5% growth? What are the drivers for that? So I think very quickly, just to recap the drivers, I think there are two essential sort of pillars of growth. One is what's happening on the consumption side, the favorable demographics, and on the investment side. And recently, there is something on exports also, both on non-IT services exports, that is GCC coming particularly post-COVID, and also manufacturing exports. But the single most attraction is on the what's happening on the demographic side. I mean, all of us know the median age is 28, would remain favorable. I mean, the dependency ratio as per economic survey will remain favorable all the way up to 2047. And that's the period actually the Amrit Kal is sort of also referred to. So almost 2.5, 3 decades where the working age population, the household number of people working will increase. And then you have multiple things. You have gig economy, more women in workforce, urbanization. All that means that this is a country which needs to provide 1 crore jobs for next 10 years. And as people earn more, save more, spend more, and that is the trigger for one of the dimensions of growth. And of course, whether it is demographic dividend or curse depends on whether the system can provide enough good quality jobs. The second side, on the investment side, I mean, as many of you have visited, let's say Mumbai, the kind of transformation we are seeing now, probably I have not seen in the last 25 years, with metro, coastal road, etc. And here, all three pieces of investment, which is by government, by household, and by corporates, are looking pretty solid. I mean, government has a national infrastructure pipeline of 110 lakh crores spelled out over a 5-year period. They are doing heavy lifting of the post-COVID. In fact, the absolute amount of investment put by government, both state, central government bodies, from 2016 was about 5.5, 6 lakh crore. That's now almost 19 lakh crores. That's the amount of capex that's been put in the system, and there is a requirement for roads infrastructure. On the household side, again, we have seen a revival in real estate sort of cycle, and that again is sort of lifting. It's a big, from a stock market perspective, it's a very big sector, not real estate stocks, but the entire ecosystem of building materials, etc. And there was a downturn from 2012 where the number of units sold were 360. It's only recently we have crossed that. And the third piece why corporate capex should, not large size capex, but what should accelerate over time is that never ever earlier, or not never ever, but after 15, 20 years, we are seeing one of the best corporate balance sheet in terms of debt to equity. Government balance sheet is very, very, very fine sort of shape. Household balance sheet is decent. And a banking balance sheet is also literally pristine. So I think the medium-term outlook is good. So I think confidence is on 6.5, 7% sort of growth. That means 12% growth. And that's where this number math comes in, whether it is 7 trillion, 10 trillion over time, the potential is significantly low. Just to end, I think the trinity of wealth creation is not growth. It's the growth, longevity of growth, which I touched on, but also the character of growth as defined by what in company parlance we call return on equity or so. So if you look at China last 30 years or even 20 years, they would have grown at 13% dollar returns, the dollar terms in the GDP growth, but the market returns is less than 3%. So because the ROEs are less, because they were capacity creation, etc., so it was not an accretive investment. US has a better ROE, so the growth was say 4%, market returns are 8%. India, for the first time, we are seeing our ROEs increasing, has crossed US, and by the way, it's now touching almost 14-15%. So I think that over the next couple of decades, you have all three coming in: growth, and it's not high growth, it's the longevity of the growth, which is very important, 11-12% growth with a good ROE. And as long as valuations are reasonable, that means wealth creation would sort of happen.
Thank you, Nilesh. Shankar, your views on this?
So I think most of the things that have to be said have been said. So I should, and obviously, both are very accomplished gentlemen. So I have to say something which is going to make me look more accomplished, right? So I can tell you I am the earliest bull on India amongst all of this, and probably from all the people in the audience, because I turned bullish on India in 1975.
How old were you then?
I was, I think, 11 years of age or something like that.
Okay, he
I don't
clearly
think
beats
anybody
us.
in this room can top that. And I'll tell you why that happened.
Not 70, but 1964 he was bullish.
Yes. So wait. So I turned bullish because one day in school we were taught a lesson. I think it was in geography or something, in which they gave, I don't know why the school was teaching that, but it was a good chapter, and the chapter was India relative to the world on various parameters. And that time it was only parameters like radio transistors, not transistors in chip, actually the radios. Okay, television, bicycles, because cars, though we were not even, on the map. And that number, wristwatches, shoes, something like that. And the number was in decimal, like we had one wristwatch per 200,000 people. It was some very shocking number, all the parameters. So I came back, I was in depression. So my father asked me that what happened? I said, look at this data. I mean, we have no future. I mean, we are nowhere on the map. We are not even close to even Asian countries. And my father, who was a mining engineer, had no idea about all this. He said, beta, we can only go up from here. Right? I mean, this number 5, 10, 20, 100 years from now will be only trending upwards. So why are you depressed? You should feel happy. And that really put out a light bulb in my head that the old man, he was a smart guy. I mean, he told me something without knowing anything about investing. He hit the nail on the head that ultimately in India, we are so underpenetrated in practically every, not services, but in goods, that the trend has to be up, literally. And the other interesting thing is that when I started my journey in the stock market in 1989, 1990, so in our stock market, little cozy club of friends, and we used to drive to work or take a train or do whatever, and we used to say that, I mean, so one of the friends was very negative on India. And I used to ask him why. And he used to say, ki, in a country where there are no roads, how can we have a bull market, boss? Look at what we are traveling on every day. Then the term we called it is a roadless country. And the thing that I used to tell him is, boss, till we don't have roads, we'll have a bull market. Because that is the entire India story. We have nothing. We have to build roads, we have to build the metro, we have to build the flyovers. Other countries like Japan built it in the 80s. Now they have no growth left. China built it over the last 30 years. Again, petering out. We are still so underpenetrated, literally in even public goods like roads and infrastructure, that we can keep building for the next 15, 20, 30 years and still not be saturated. So all I can say is that, the headroom for growth in India is huge. We are still on a per capita basis, and we keep talking the aggregate figure of 4 trillion and 10 trillion. On per capita, we are still $2,000. I mean, that is a figure lower than most sub-Saharan African countries. We will go up. There is no two ways about it. I mean, that is the inescapable reality which my father saw back in 1975. And I still see the same reality. So there is nothing but a permanent headroom for growth, at least in our lifetimes at least.
Thank you so much. And this is what stalwarts bring to the table. Hiren spelled out very well that what are the ingredients required for a country to become a superpower. Nilesh exemplified how sectoral growth is happening, and Shankar helps you become an eternal bull on India for the times to come. We have so many more things to grow in India. Moving on, I would like to get a little more micro for our investors' benefit as to what sectors do you think will define or will help get this growth in the country? Like in our earlier sessions, and you all have said, there are particular sectors where we see more growth. Maybe each one of you can take a 2-minute time on it and tell us what sectors one should look at. Hiren, do we want to start with you?
See, if I were to use Shankar's argument, there is growth in every sector, right? There's so much under penetration. But I'll tell you something very interesting which is happening in India is, and to some extent, my previous colleague, when he was explaining the Aqua strategy, said, right? Sectoral themes change. Something grows for years, everybody gets invested into those stocks. And then let's take the classic example of HDFC Bank or private banks, right? HDFC Bank has given no return for the last 4 years. Does it mean that India is not growing? Does it mean HDFC Bank is not growing? No, that doesn't mean that, right? So you could have growth and no returns in a certain stock or a sector, because there are a lot of other factors at play. How over-invested is everybody in a particular theme or in a particular sector? And if we were to look at that, and if I were to talk about a little more medium-term perspective, then you need to go back and look at the sectors that did well between 2003 to 2008-9, and you can add a couple of more sectors, right? That was the bull market of India, which was largely driven by cyclical sectors, as everybody says, right? So your real estate, capital goods, power, infrastructure, roads, real estate. Suddenly, between 2010 or 2012 and 2020, all these sectors had become no-goes, PSUs, right? They were all supposed to be dirty, low ROC, low return, low corporate governance, very cyclical sectors. And everybody went and invested in the big banks, the great consumer franchises in India, the very good quality companies, and also the period between 2011 when all the scams broke out in India up until COVID. India's macro went through a very, very tough period. And we did some very strong reforms, and all reforms are initially painful and growth dilutive. The dividends of those reforms you only get over a period of time. And I think what we are seeing now is the dividend of all the hard work and the cleaning up that has happened in India in the last decade, right? So if you want a very simplistic view, all you need to go broadly is to look at what kind of sectors did between 2003 to 2008. Now, that doesn't mean that a consumer company won't grow in India and you won't make money in India, or you won't make money in India in a private bank. And that's why you need to go to specialist managers who can figure all this out. But broadly speaking, I think the thought process of this government, which is very top-down and which is predicated on building infrastructure and doing supply-side reforms in India, means that certain sectors from an investment perspective will have better outcomes than other sectors, right? So to me, the current bull market in India, which started from the COVID lows, looks very similar to the bull market of 2003 to 2009. And I think if you have a slightly better allocation to what is called as the very hard sectors in India, or the very cyclical domestic manufacturing kind of sectors, we're going to make a lot of money there. I'll give you one example of real estate, right? In 2003, if you take the top 800 companies in India, the sector weight of real estate was zero, almost negligible. By 2007-8, in that bull market cycle, the sector weight went up to 6%. And in the next cycle, it went down from 6% to 0.6%. And now it is just 1.2%, right? So you have these 8 to 10 year cycles where capital, returns change, sectoral preferences change. And as I said, broadly speaking, in India, if you invest, you will make money. But I think leave it to the experts and the managers to figure out what sectors that you should bet on. But my sense is that there has been huge underinvestment in a lot of the cyclical sectors in India. And that's where likely over the next few years, you will make far better returns than the leaders of the previous cycle. As my mentor and partner, Mr. Rakesh Jhunjhunwala used to say, Naye race ka naya ghoda. Every bull market has new leadership. And I think the leadership has changed. I think most active managers and investors are struggling because their portfolios are filled with leaders of the previous bull market.
Yeah, Nilesh.
I'll add on to what Hiren said, and a couple of caveats. First is that sometimes what we see the narrative of sectors which were doing very well in last few years and maybe may not be the best stocks because the valuation may be factoring in. In fact, in India story also, partly I think is markets are forward looking, so it's part of it is captured. So there is no large pocket of significant dollar for 20 cents sort of opportunity in my view. I mean, something which is reasonably priced today is large retail private banks which have underperformed. But from a longer term lens, clearly I will concur with what Shankar mentioned, that consumer discretionary looks very interesting. There's confluence of multiple things as per capita increases from $2,300 to say $3,000 or so. Incrementally, people spend more on discretionary. People will not spend on soaps and all. One can probably premiumize from Lifebuoy to Dove sort of thing, but you'll not use more of that. So a lot of subsectors come within this. Wherever there is a penetration gap, let's say AC is still 6-7% penetrated, or passenger vehicle is much lower penetrated than two-wheelers. I mean, there's a long headroom to grow. So growth is strong. And many of these sectors, particularly some consumer goods, etc., where there are entry barriers, I think there is another theme which is taking place, which is more formalization happening. So strong is getting stronger, listed companies, the leaders, and weak or the regional guys are getting marginalized because of taxation, because of a lot of other issues, compliance, etc., GST. So I think consumer discretionary and multiple subsectors, be it leisure. Leisure, of course, is slightly expensive, but many sectors, actually at this point in time, there is a portion of economy which all of us know is not doing well, the K-shaped recovery, what we talk about, the rural, low income. Within that, discretionary goods, I think from a medium-term perspective, as well as from longer-term perspective, sort of would sort of do well. Many consumer tech business also fall into that. Aspiration levels are changing. So I think that retail banks, besides that, there are enough and more manufacturing side or so. But I think only calling out sector in the context of you should link it with both ROEs as well as valuation. So one should, at an aggregate level, I think it's more like a basket approach with a reasonable return of that basket is where I would sort of put it, rather than a particular call out one single sector, because there are themes which are like Make in India and investment side industrials. In my opinion, a large part is sort of priced in also.
Yes, sir.
So again, I have to say something which is not already said. Okay. Yeah, please, next time you start with me.
Yes.
So my view has been very clear that in the last 3-4 years since COVID, and 1 year particularly after COVID, that the game in India, had changed a bit from being dominated by the large caps to becoming a country of literally tens of thousands of small cap companies. So I took that bet, and it has worked out, much better than I thought it would. But the reason for the bet was very simple. And I've said this on many fora, but I would like to say this here, that $3.5-4 trillion economy in aggregate is large. But what is more significant is that means each part of India, if you divided India into 4 or 5 zones, each part is between $500 billion to $1 trillion on the average. That is the equivalent of the GDP of a Turkey, for example. $1 trillion is more than the GDP of Saudi Arabia. I mean, each part of India is now equal or larger than most countries. And therefore, that changed the investing thinking that I had, that rather than look at large players dominating India, I wanted to go looking for smaller players who will dominate each part of India in their own backyard, in their own neck of woods. And that theme, actually speaking, again, more by luck than by design, turned out to be a good theme because I managed to find companies which were serving only, the eastern part of India. Selling snack food or selling televisions, or some company, just selling apparels, or some company selling soap, each doing in 2 states, UP and adjoining one state, or selling in West Bengal and Odisha. I mean, those sizes of those markets are delivering top line numbers for these companies which are 500 crores. I mean, it was unthinkable 15, 20 years back that tiny one state players could have top lines of 200, 400, 500 crores, bottom lines of 20, 30, 50 crores. And that, I think, is the real story in India, that I want to go and buy companies. Forget sectors. I want to go and buy regional niche players serving one state or 2 states, because they are able to be much more nimble than a Titan, much more nimble than a Hindustan Lever, much more nimble than a Larsen and Toubro in respective sectors of the economy. They know the local market, they know the politics, they know all the decision makers in the governments or at municipal corporations or the retail chains, the kirana owners. They have far more local knowledge than a large player will, and they can do ticket sizes which are much smaller than what a Nestle can do or a Lever can do for, let's say, in the snack food category. One good example which I can talk about is a company called Senco, which went public, I think, a year back. When I met the promoter, he had come to meet me here, a nice Bengali gentleman. And what he told me was amazing, that I'm going to the smallest kind of villages in West Bengal and setting up my jewelry store. Titan can never be viable in those places. It won't even look at doing a store in those places because it has to have bigger footprint. And by the way, even the hiring cost for a Senco versus a Titan, or a Nestle versus a snack food company which is regional, is vastly different. Nestle will hire somebody at 100,000 rupees a month. These guys will hire at 10,000 rupees a month. So at every level, the cost advantages of smaller players and the addressable market that they have, that huge gap, in my view, is the sustainable theme in India. Large players will continue to lose market share to smaller players. I mean, I'm not saying as an absolute truth, but I think incrementally smaller players will chip away at the growth and the market shares of larger players. You've seen that happen across industries, because now each part of India is enough money to go around for the smallest of small players. I think that, to me, more than a sectoral bet, was more a regional bet versus a sectoral bet. And that frankly, is really, if India goes to 10 trillion, then each part will become worth $2.5 trillion. I mean, just look at the scale of what will be each part of India. India's total GDP was $200 billion when I entered the business. 200 billion, that was the entire GDP in 1990. Today, we add $250 billion in growth every year. See, that's a scale differential today. So I am playing the regional theme, not necessarily sectoral theme.
So very well said. That a lot of countries within one country, and that's the kind of growth we're looking at. Related to that, I want to start the question with you now. How is digitization and the digital transformation that we've seen in India, where it's a leader, is helping get into this countries within country and the growth, and how is the world looking at it?
No, I think one of the reasons why we have done such a fantastic job with the digital revolution is that we did not have digital anything at all, right? We used to wait months to get a phone line, right? So sometimes when you're late to a party, it is sometimes better because you know what you need to do and what not to do, what the other fellows who came in earlier, the mistakes. You can leapfrog technology, you can leapfrog generations. India came late to this party, but because we came late, we figured out much better solutions, much more. Obviously, Indians will do everything at a fraction of the cost of any other country. Particularly in IT, we are the leader.
Yes.
So what Nandan Lirekani did on the national ID program, it was a move in 2005, I think, when it started. Today we are reaping the rewards of that one game-changing move to bring a whole slew of services directly to the bank accounts and doorsteps of Indians. So, those are foundational things. We can talk about it for a long time, but I know time is short. I think what we have done on the digital front, whether it is the payments or Aadhaar, is something that other countries will really look up to, and we continue to now be like literally the gold standard in digitalizing the economy. I think India is far ahead of the US by far. I mean, there is no comparison, and which is saying a lot for a country as still relatively poor in terms of per capita as India.
Right.
By the way,
Hiren-
before we end, I think we should also spend 5 minutes talking about the risks.
Yes.
Because, as investors, we should always, as people who have seen cycles, all the gentlemen here are very accomplished. You are very accomplished. We've been a long time in the market. We know there are risks to every investing thesis. Please
Yes.
spend 4 or 5 minutes on that also.
Sure.
And I don't want to sound negative. I just want to make it clear that every positive thing also has some negatives, and we should make the audience aware of those things.
Right. Hiren, we want to ask you, you've been running a large fund and you all were the first ones to move to Gift City, which is our offshore vertical from the country. How has your experience been? How are investors globally looking at it? And for offshore investors sitting over here, what advice do you have for them?
Yeah, we've been managing foreign capital since 2006-7, right? And it was quite stupid. And this also tells you how India is changing. That for Indian managers who understand India and wanted to attract foreign capital in India had to go outside of India and set up in Mauritius or Singapore their funds and then bring that into India, right? Now, the Modi government has set up something which is called a gift city, which is very similar to what you guys have here, which is DIFC. It's an international financial center. It's a great regime. And we've moved our fund, which was initially domiciled in Mauritius and Singapore, into GIFT. We were the first fund in India to move. That fund has a 15-16-year track record. Now, how is it different for you? I think, even today, for example, NRIs find it very difficult. They don't want to file tax returns in India. They don't want a PAN card. So you don't have to do any of those things, right? You don't need to have a PAN card. You don't need to file your tax returns. You just invest in a fund like you would invest in any offshore dollar fund. NRIs, can keep all their assets in dollars. They don't have to kind of bring it in rupees and then repatriate it back in dollars. So it's, to put it very simply, the regime is super smooth. You don't have to rely on tax havens and uncertainty around taxation. Costs are much lower. What we've done is we've passed on all the benefits of lower cost to our investors by reducing the cost structures for the fund, right? So I think it's a very progressive regime, and the whole idea is to ease of investment, as they say. I would just want to spend 1 minute on, I've been talking to a lot of you outside, and also in general talking to, our job is to keep talking to foreign investors about investing in India. And one pet peeve that everybody has is about valuations. Now, the thing is that if something is good and growing, you have to pay up for it, right? And, I can keep going and rattling numbers, but that's not the idea over here. To me, India is not going to be cheap unless there is a big global crisis. And we'll talk about risk, as Shankar mentioned, right? But I don't think that given the kind of work that we've done at the macro level, the kind of visibility and the growth opportunity that we have, please don't be under any impression that you're going to be handed down India cheap. You want to drink coffee in a 5-star, you have to pay up for it. So you want growth, you want visibility, you want superior returns, You want visibility of growth for the next 10 years, better learn to pay up for it. You're not going to get India cheap. Or you can keep waiting eternally, and if you believe that you can really time it, good luck to all of you. But I think people will be wasting their time if you intend to allocate to India. My sincere advice would be, don't try to be too cute and try to time, because you're not going to get India very cheap unless there is a big crisis.
Agree totally. And, growth comes at a price. While I also meet investors here, and everyone talks about the expensive valuations, but no one talks about the kind of growth that India is proposing. So this will remain a very, very powerful country with high growth.
It's like very
and high
simple,
expense.
right? I mean, China is available at 8 times and India is available at 21 times. So you can decide. I'm not saying China is a bad investment destination, but there is a reason why China trades at 8 times and there is a reason why India trades at 21 times.
No, and the thing is that in India, I remember when Templeton first came to India in the early 90s and we had a meeting with them. Mark Mobius, was a good friend. I mean, he showed me the list of his stocks and all of them were trading at about 5-6 times earnings. And I told him, Mark, you cannot buy these companies. He said, why? He said, I said, in India, we look at the PE ratio differently. He said, why? I said, this is the number of years the company is going to be in business. So if it is 5 times earnings, trust me, these companies will be out of business in 5 years. He went and bought all Garden Silk Mill and all this rubbish. All of them are out in 5 years. Yeah. So in India, quality will come and 100% you will not get cheap. India is a very smart market. It will not give you the easy, great stock at a 4 or 5 times earnings. You're not going to get that in India. Yeah. So forget about it. Those days will never happen. In my career, it's never happened. So it's not going to happen ever. You have to pay up for quality. And quality does get rewarded in India, always.
Yes. Nilesh, you had mentioned last year in one of the interviews that you would continue to invest in India, in Indian equities, despite the volatility that's there in the markets. Do you hold your view still?
Yeah, I mean, that was probably in different contexts in terms
Yes.
of our audience is more granular, millions of folios and all. And the popular mode of investment is the systematic investment plan. In fact, that is one of the areas we probably didn't touch, is also helping the markets. What is cause and effect? Probably, I don't know. It's become so big. SIP is almost $2.5 billion. So the idea many times in investing for that sort of large section of investors is the best thing is not to do much, just to continue with that time frame, mind frame, and invest for longer term. Unless some unusual events, outlier happens like COVID, where you get something very cheap, then one can put those discretionary lump sum money, or the other way around when it is very obscenely expensive, which is a 25 PE types or so. So I think that was the thing. It still holds true that in equities, all you need is time, if, like Shankar said and Hiren said. I mean, if quality, which is defined by growth, ROE, etc. Even if you pay slightly higher or so, what you need is time, and that's where in the context was that you keep on investing in a systematic way. More so now, there's not a market where you put large money at one go and there could be volatility. Maybe Shankar could tuck on risk or so. But to capitalize on volatility also, SIP sort of makes sense. And so one should just stay invested in that.
Yeah, so allocation to the country, a most important factor. While you look at the growing economies, top 4-5 countries, the highest growth offered is from India. Of course, that comes with risks. And as Nilesh mentioned, allocation is very important. We're looking at a lot of important events, US elections, Indian elections. All the risks come with this growth. I will leave the forum to you all to talk about the risks associated so that the audience is amply clear that it's not only growth story and you invest your money and you keep getting positive returns. Hiren, would you want to start, or Shankar?
So I can say something different.
Okay. No, so the way I look at it is the risks are, I'm not concerned about a global macro risk because I think that macro risk is behind us. I mean, we have now, somebody told me we have 13 wars going on in this world right now. Big or small, which is, I don't think it's ever happened in the history of the world. And we have dealt with it, countries have dealt with it very well. In fact, I was reading a very interesting article in The Economist the other day, which says that, it made a good point, which is my belief, that we have become better at dealing with crisis overall as people, as countries and nations. Earlier, if we had so many wars and these kinds of significant wars, market would have been in a tizzy. But nowhere in the world does the war appear or wars have appeared to have any significant impact. US was supposed to be slowing down, big interest rate hike from like literally 0 to 5, 5.5. What is the market? Everything is flying off the charts. So we have become more resilient as people to deal with crisis. But that said, I can only see in India, if I were to look at risks, I see two major risks. Number one is we have seen this bull market getting driven by one major factor. And the bull market is 4 years old in India now. Okay? And that is a high fiscal deficit. Okay? Because bull markets need money. As simple as that. That's the fuel. Where has the fuel come from for the Indian bull market? It has come in the form of very high fiscal deficit. Why has the high fiscal deficit happened? Because the COVID had a one-time effect of allowing the government to balloon the fiscal deficit to like whatever it was at the peak, maybe 8 or 9%. And from there, we are dialing back slowly to 6%, 5.5%, and then 4.5%. Imagine back in the day, if fiscal deficit went from 3.5% to 4.5%, the markets would have tanked and crashed. Bond markets would have gone into a tizzy. Now we have normalized our thinking to say 5% is good or 5.5% is good. But the fact it's not good. It has taken our debt to GDP up sharply higher from the last 10 years, from like in the low 60s to I think in the mid 80s, if not the 90s, depending on what calculation you take. We need to be mindful that this high fiscal deficit strategy, which is of course a good deficit because it is capex deficit, but deficit is a deficit. It will have long-term effect. China ran the same strategy. I had written an article in the papers in 2012 warning that the China model is going to end very badly, and exactly 12, I mean, that started to end even within 5 years of that. We don't want to go down that path of high fiscal deficit, high capex, because eventually that bill will be borne by the exchequer and the taxpayer. I believe that is a significant risk. Second thing is that, guys, ultimately, no matter how much we want to wish away cycles, we live in a cyclical world. We have had 4 fantastic years of a bull market. This bull market is not a young bull market. It is a middle-aged bull market or maybe a little older bull market. Okay, but I'm very fit. I'm 60, so I'm not saying that just because you are old, you have to become unfit. All I'm saying is that 4th year of a bull market, and now we are going to go into a 5th year now. Just be a little mindful that return expectations need to be tempered down. We have had just literally people who could not figure out a difference between a balance sheet and P&L have become worth 100 crores. That tells me that we are kind of in a bit of a frothy zone. Just be mindful of that. Those are my 2 major risks here.
Hiren, you wanted to say something.
Yeah, I mean, I don't want to list down a long wall of worries. I mean, Shankar covered 3 points, just 2, 3 points which are not, doesn't make a factor whether not to invest or so. So not, but the some of the challenges are, one is, I think from a medium term perspective, if we are still very sensitive to oil. So if oil were to, this is not a base case scenario, goes to 100, 110, something like that, then a lot of things goes at a macro level, current account, interest rate, inflation. So one has to sort of watch that number. Second is, all said and done, a lot of reforms, while they are one-sided, etc., I think is driven by the leadership. And there's a consensus that it would continue, and it would, I mean, that's the confidence. But one has to again look at, it's quite sort of a very large sort of risk. And lastly, I would agree with some part of Shankar and otherwise that I think the starting point of valuation in some cohorts of the markets are not cheap. We are seeing SME IPOs getting 20,000 crores. We are seeing small caps, defense, and many MNCs, EMS companies with 200 crore turnover being 6,000 crore valuation starting point and all. So we have seen it again various cycles. So one has to be mindful and do the checks of looking at the fact sheet, because lot of stocks particularly and it happens to be, I'm not painting with the same brush on all small caps because the universe is wide, but quite a few of them I've crossed. I don't think they have margin of safety left. So one has to be very, very careful because it won't be probably quotational. There can be permanent loss in those sections.
Yeah, I think I agree with both of them. I think just to take on Shankar's point, that I can say that our ability to deal with risks as a country has improved. And that was shown during the COVID crisis, right? The entire world thought that demand will get destroyed and just printed money and gave people free money. And we had the ability to think differently and act differently, right? So while we had deficits, we spent all of that on supply side and infrastructure spending rather than just giving away money free to people, which has now caused inflation, and now everybody is trying to fight inflation in the Western world. To Nilesh's point, yes, I don't think $100 is a problem anymore now, and I'll tell you the reason why is because today India's software exports is higher than our oil import bill at about $90 to $100, right? So if it goes to $140, $150, then I think certainly it's a near-term risk to India, because I think India is still dependent on imported energy. And the third thing is that, look, every bull market will have pockets of excesses. I think one excess that I can clearly see, obviously some sectors Nilesh mentioned, is in the SME. And the second thing is the mad rush for IPOs in India, 150 times, 160 times oversubscribed. And I have a standing joke in my office that if existing listed companies go private and then go IPO, they'll have a better valuation, right? So, so this mad rush for IPOs or, very small companies where we don't know where the money is going, in SME IPO, the promoters are selling 50% of their stake and running away, and the investors are holding the baton because there is a nice momentum in the market right now. So you got to be very careful about what you buy at this stage in India. I agree with Shankar that it's not a very young bull market. Having said that, I still believe that longer term, India per se is an asset class to be in. If you're not in the wrong companies, there may be temporary loss of value, but unlikely that if you stay longer, there'll be permanent loss of capital. So don't do anything which will give you permanent loss of capital. I think the world is full of risks. We are back into the era of wars. We are back into the era of trade wars. There are so many elections, so there will be volatility, but that's all fine. But I think, yes, we should be mindful of what kind of returns we can get. We've all been lulled into superb returns in 2023. So don't go into India saying that I'm going to make 50-60% returns. That's not going to happen.
Thank you so much. High growth country comes at a cost, at a premium, with its risk. Choose your managers wisely, but don't miss India. That's all that we have to say. Thank you, gentlemen, for being here.